Inflation now stands at over 10%. It is a tough road ahead.
The outlook is bleak. A long recession, falling growth, rising unemployment, and in Petersfield in Hampshire, an anxious wait for an announcement on interest rates.
The Bank of England has raised interest rates by 0.75 percentage points to 3%. But the increase might be a bit less than that because...
For us, everything goes up and it puts us still in a really sort of difficult position.
Janine provides temp workers to the care sector. The rise in interest rates to 3% doesn't just affect the £40,000 of business debt she owes, but impacts the £42,000 in outstanding invoices customers owe her.
Some people just look at that and think, oh, well, it's the interest rates going up. They don't look at the bigger picture, that it's everything goes along with that, and cutbacks have to be made. I know the knock-on effect that's going to have is going to be, it's even longer before people will be able to afford. They've got to pay their electric bills, gas bills, heating,
mortgages.
lighting, mortgages, you know, rents even will go up.
60 miles away at the Bank of England, the Governor, Andrew Bailey, explained why interest rates need to go up if soaring prices are to come down.
The fact of the matter is that if we don't tackle the inflation, then the problem gets worse.
But he also painted a dire picture of the UK's economic landscape, and even more pain to come. Today's 0.75% rise is the biggest sustained increase in interest rates in more than 30 years, coupled with the longest recession on record, possibly 2 years, according to the Bank of England, leaving us with an unemployment rate of perhaps 6.5%, almost double what it is now. 2 weeks ago, the Chancellor warned of eye-watering difficulties ahead for the economy. Today, his words were no more comforting.
There is a global economic crisis. The IMF, the International Monetary Fund, say a third of the world's economy is now in recession. And the best thing the government can do if we want to bring down these rises in interest rates is to show that we're bringing down our debt. Families up and down the country have to balance their accounts at home, and we must do the same as a government.
People are not in a position to withstand these sorts of interest rate rises when we've got rising food prices, rising energy bills and now higher mortgage rates as well. The government have left us exposed because of low growth and a cost of living crisis.
The ink spots of this economic crisis are spreading.
So I moved here when my son was like 6 months old.
Agatha is a professional, a single mother who works full-time. She had to remortgage her flat last month, but soaring interest rates have drastically changed her and her son's fortunes.
Are you looking at going to food banks?
Oh yeah, absolutely, yeah.
For the last few years, the mortgages cost £470 a month. Since remortgaging...
Now I'm paying £717.
That is a big increase.
Yeah, it's absolutely huge. It's not anything I can afford, not even a little bit. It's because of the decisions I made.
How did you feel when you saw those numbers?
Yeah, I was on my way to work and I had a panic attack. It's really upsetting just thinking about it, actually. It's like really, really hard because I had to call my colleague, and she came out to find me and just she just sat with me while I was just like bawling my eyes out. Yeah, it was really hard.
Agatha's story is being played out over dining room tables across the nation. Sustained rate rises affecting not just those with mortgages, knock-on effects for many renters too. Property website Zoopla are now predicting a 5% drop in the value of homes.
If you haven't got a cheap mortgage arranged or you're uncertain about the outlook, we've seen a 30%, 40% drop in new buyer demand. So a lot of people are now just deciding to sit out the next few months until Christmas and look to see where rates are as we start January, as to whether they can afford to come back into the market.
Today it was down to the Bank of England to make the hard choices. In 2 weeks' time, it's the government and the long-awaited autumn statement. But we've already been warned what to expect. Tax rises, spending cuts, yet more grey skies.
Well, is it inevitable that the economy descends into a protracted recession? Here's our economics reporter, Neil MacDonald. Neil, I've asked you this question before. How bad is this?
Well, it sounds terrible. We may be able to find a bit of a silver lining in this very cloudy outlook. It's to do with the way the Bank of England forecasts what's happening to the economy. And this does sound technical, but it could make a big difference to what's about to happen to us all. So the bank's forecasts are based on what the financial markets think are going to happen to interest rates over the next 3 years. And those expectations really shot up during the turmoil that surrounded the mini-budget in September. So financial markets think interest rates could go all the way up to 5.25%, and that produces a big drop in economic growth, down to 2.9%, and inflation falls to 1.4% in 2 years. And the Bank of England thinks that it would carry on falling after that, all the way down to 0. Now, the bank's objective is inflation at about 2%, certainly not 0. So what these forecasts suggest is that interest rates at that level are imposing a squeeze on the economy that is actually far too tight, in the Bank of England's opinion.
So what is going to happen then?
Well, helpfully, the bank does also do a forecast based on interest rates if they don't change. So if rates stick where they are today, 3%, then you can see growth still falls, but by much less, and inflation comes down to around about 2% roughly on target. So what this suggests is there is some good news out there, which is the bank thinks that interest rates do not need to go up as much as financial markets currently believe. And of course, that would be welcomed by only the 2 million households with a fixed rate mortgage deal that's due to expire next year.
Definitely a silver lining I want to hold on to. But we are still facing a recession, though, aren't we?
It looks like that. This good news is relative. There's still likely to be a very big squeeze on people's incomes. There is a change in where that squeeze is coming from. This year, it's all been about energy bills. Next year, it's probably going to be more about these tightening financial conditions, not just mortgages, but any form of borrowing, whether it's by companies or households. And the bank is still worried about the way in which wages are rising very rapidly, and it fears that companies may be tempted to pass on those higher wages in the form of higher prices. So while interest rates may not go up quite as much as everyone was fearing, they are still likely to go up from here.
Neil, thanks very much. Well, earlier I was at the Bank of England and spoke to the Governor, Andrew Bailey, after his announcement and began by asking him how worried he was about the prospect of a downturn longer than the Great Depression of the 1930s.
Well, I am concerned, obviously. This is not something that any of us want to see. I would, however, come back to the huge shock that this country and other countries are experiencing at the moment to our national income. And I'm afraid it's predominantly coming from events in Ukraine.
Right, so you've had no choice than to act as you did today.
Yes.
But I wonder, given that taxes are at their highest since World War II, people are already struggling to pay for food and energy bills and so on. You've just announced the biggest increase in borrowing costs in more than 30 years. And I just wonder whether we and you should be more worried about the prospect of the longest recession on record than inflation, which you say, well, you've got high expectations, it will peak next year and fall pretty rapidly thereafter.
But what I would say is that unless we take the action to ensure that inflation does come down, the outcome will be worse. If we don't restore price stability, if high inflation becomes embedded, it becomes worse, and it takes even more action to then get it out of the system.
But given that we're most likely in recession, once you've taken that action on inflation, which you've done today, should we expect fairly soon thereafter, next year perhaps, that interest rates will start to be cut?
Well, I'm not going to make any predictions about when we will start to cut interest rates. What we did do today is give a very clear message that, in our view, the financial markets have overdone it in terms of how much interest rates will rise further from here.
But it's a very rocky road ahead.
We are seeing some huge shocks to the economy at the moment. I mean, that is, I'm afraid, a feature of the last 2.5 years or so now.
We speak in the aftermath of the mini-budget. You had to promise to buy £65 billion worth of government bonds to protect some pension funds. I wonder, looking back, only a few weeks, but it feels like a lifetime, how close did we come to financial Armageddon? Well, we certainly reached a point where markets were very unstable, and these were core markets. This is the government bond market, which is in many ways the most core of all, if you like. And it was becoming unstable, and it was affecting, as you said, pension funds, for instance, and how they were operating.
And our worry was that when you get into that situation, this can easily spread very rapidly, and then you have a huge job on your hands to get it back under control. So we had to step in quickly, and we had to step in quite decisively.
But we were hours, we were days away from potential total meltdown?
I think at the point when we intervened, I can tell you that the messages we were getting from the markets were that it was hours.
Hours?
Yes, yeah.
Was that the most frightening moment of your tenure as governor, in your lifetime, really?
Well, I mean, I was playing quite a leading role in the Bank of England during the global financial crisis, so I've had some experiences, but it's not one you ever want to be in. And
was this worse than that?
Hard to compare. I mean, I think the global financial crisis had some pretty unnerving moments. And so you were in this building during the Lehman weekend, for instance. It was pretty hairy at times. So I'm not sure I could give you an exact comparison. But this felt and was a very real threat to financial stability.
Given that it was self-inflicted, really, at that point, did you feel angry at what had been unleashed by the government?
Well, I think the thing about the Bank of England and my colleagues, because they really deserve all the credit for this, is that this is an institution that sort of rolls its sleeves up and gets on and burns the midnight oil and gets on with the job in the situation they face. We don't spend our time sitting around sort of recriminating.
And what had been thrown at you was also some quite personal attacks from senior members of the government at the time. I mean, the business secretary saying that the run on the pound was in part caused by your failure to raise interest rates faster. Did you feel that was entirely unjustified, unfair, or did they have some merit?
Well, I felt it was wrong as an observation. I'll be honest with you. And what I would say is, since we've observed markets now correcting themselves, and if you ask, well, what's been the change in certainly before today? I mean, what's been the change in policy in the intervening period? It's been a change in fiscal policy. Obviously, we've changed monetary policy today, but not until today. So I'm afraid I think that comment was misplaced. Moreover, I think there were comments about it was due to global markets. I mean, I don't really think that is the case. I think there would certainly global markets have had shocks this year. We've had common shocks. Ukraine would be an example. But this was a particularly UK issue.
Just finally, there are those who say that the markets effectively ousted a Prime Minister. Do you have some concerns about the way that happened in a democratic world?
Well, I'm not going to draw conclusions on sort of, who was responsible for what in that sense. I think the markets, however, reacted to a highly unstable situation, and I don't think we can be surprised that markets react to those situations.